Good morning, everybody. Welcome to today's webinar. My name is David Logan. I'm one of the partners at Logan Katz LLP. It's a CPA firm in Ottawa and Toronto. Welcome to today's session. It's part of a continuing weekly series we started about 4 or 5 weeks ago called Planning to Catch. And the topics are meant to help businesses through this tough period we're all experiencing with COVID-19. The topics to date have been arranged around various issues we see with clients and people we talk to, that common issues that people are facing trying to figure out how they're going to get to 21. Today's session is on a very fundamental topic. It's the value of good bookkeeping, and the value of good bookkeeping really builds to the value of good financial information to allow you to navigate into what's going to be a continuing difficult year for a lot of us, I suspect. So the purpose of today's webinar really is not to try to convince you to become a bookkeeper, but maybe just to refresh, if you're not strong on your bookkeeping for your business, or you're thinking of getting into a business, is just to reinforce some of the basic comments on bookkeeping. The seminar I'm going to do today, it's an hour-long seminar. I welcome questions throughout it. So also on the call is one of our staff. Her name is Stacy. So she will be seeing the questions and asking them throughout the webinar. So please don't wait to the end. You're welcome to if you want, but it's probably more useful for yourself to get answers as I go through it. A couple of weeks ago, I also did a webinar on financial projections. Both of these webinars, the one 2 weeks ago, the one today, they're a brief version of what I do with Invest Ottawa. And if you're not familiar with Invest Ottawa, please Google it. But for both of those, I do 2-hour webinars on both these same topics. So if today's session is too brief, there's a longer version if you want. What I'd like to do now is just share my screen and start working through some hopefully useful slides to help reinforce some of the topic points I want to go through. So it says business basics in the new normal. I don't know how normal it is for most people in this call, what's happening with the world. Obviously, there's the personal side of our lives, but the business world is quite different for a lot of us. Some people, it's been very destructive, the loss of being able to open for business, the loss of ability to travel for business, on and on it goes. So the new normal is our version of trying to help you navigate some of these topics. As I said, the value of good bookkeeping, it really goes back to, I'm just going to reinforce a couple points in the agenda, just why good bookkeeping, and then going through the financial statement definitions, and the third point down, the details, debit and credit. That's where the bulk of today's hour-long webinar will focus, and I'll wrap up with a couple of general topics at the end. So bookkeeping, even if it wasn't a COVID-19 year, which it is, having good bookkeeping gives you good financial information. Bookkeeping itself is based on a principle that was set up many years ago by an Italian called Pacchioli. It's called double entry bookkeeping. So the bookkeeping I'm going to talk about in a minute, whether you're a private company, which you probably have, or you're a public company like Shopify, everybody uses the same basics of double entry bookkeeping. It doesn't matter the size of the organization. What you're going to use that information for is a whole lot of people that need information from you, whether it's CRA, the tax authorities. The second point on the slide, your business decisions. Without good bookkeeping giving you financial information, you really can't make business decisions. You're going to be guessing what your sales are at, what expenses you've got. Having good bookkeeping also means timely bookkeeping, is information that you need to decide how to change course, how to do things differently, or continue on because things are working. The third and fourth points are, there's always lots of people looking for your information. So really it's just to strengthen that, even if you felt, I don't really need bookkeeping, people you're dealing with in business will be expecting information from you. When you don't have it, you stand out as an anomaly, and it's easy enough to disregard a business who can't communicate their financial information. The key features I'd like to talk about are, the balance sheet and the income statement, but I'm going to go through some definitions because ultimately that's what bookkeeping is going to need some discussion on. So the first topic I want to talk about is your balance sheet. The balance sheet is really just a picture of your business, as opposed to the income statement. Maybe the analogy, it's like a video or a film. The balance sheet is truly a snapshot at one point in time. Typically, a balance sheet may be used at the end of the month, at the end of your fiscal year end, and it represents an equation being assets equals liabilities plus equity. This slide is kind of information rich, and we're going to have to spend a few minutes on it. Assets are things of value to your business. So on this slide, it says cash. So generally, if you have cash in your business, I think all of us would agree that is a good thing to have. It's viewed in the accounting lingo as being an asset. So an asset is something of value. Then third point down, I have this comment of normal balance debit or DR. That goes back to that concept of double entry bookkeeping. Debits must always equal credits. And it'll become clear when I go through some of the subsequent slides. So in this case, generally, all of your assets have a debit balance. I can come back through these slides, so I'm just going to go through them, not at a brisk pace, but I'm just going to flow through them, and I can come back to wrap up if someone has a question on some of the terms. So liabilities is the opposite of an asset. Whereas an asset is something of value to a business, a liability means that you owe money to someone. It could be a bank loan, it could be to a supplier. You owe them money. So it's the complete opposite of an asset. An asset is something of enduring value you're going to have for a period of time, whereas a liability is something you've got to pay back, get rid of. So it is the opposite balance. It's a credit balance. In case question comes up in your mind, why is one called a debit? Why is one called a credit? Bookkeeping and accounting in itself is a language, not unlike any of the languages we might speak, French, English, etc. There's terms in both French and English that are just there because that's the structure of both those languages, English and French. Bookkeeping has that structure. So the concept of an asset, a liability, an asset being a debit, a liability being a credit, that's the structure. And I'm going to go through one last one on the balance sheet. So far I've introduced two: assets, liabilities. Equity is the third component on the balance sheet. And really what that is how much is the business worth from a simple equation basis. Assets equals liabilities plus equity. That's the balance sheet. So again, if you're looking for an assignment of a value name, it's always got a credit balance. So a liability is a credit, equity is a credit, whereas assets are a debit. And again, if you're listening and you're saying, well, why is equity a credit? I thought if I owe money to someone, that's not necessarily a good thing, it's a credit. Whereas equity sounds like it's something of value to me. Why is that not a debit balance? Again, I have to say it's the structure of bookkeeping, which not dissimilar to English and French. When you learn it, there's just certain understandings of how the grammar in both those languages work. This effectively is the similarity for the balance sheet. The second statement then is the statement of income. So the statement of income is the analogy I gave earlier to a film or a video, whereas the balance sheet is literally at one day. Let's say today is the 26th of November. You have an balance sheet at November 26th. The income statement typically would be maybe from January the 1st of 2020 till today, November 26th. And again, there's an equation here: revenues minus expenses equals net income. So I'll just go through some of those components.
David, before you do that, I just have a question here, if that's okay?
Yeah, sure.
Is a shareholder loan an asset or liability in a corporation owned by a single shareholder and owner of the corporation?
Okay. It's a credit, it's a liability. So when a shareholder loans money to the business, it's funds the corporation has to pay back. So it's viewed as a liability and has a credit balance, similar if you had borrowed from a chartered bank. Please keep sending the questions through. When I pre-COVID world, when I've done this 2-hour presentation at Invest Ottawa, normally there's a lot of questions as I go through this, because the information I'm giving to you is something that I learned in my first year of university when I started to study to become a CPA. And I know when I was sitting in class at the University of Ottawa, I had many questions just to understand, why is an asset a debit, a liability, a credit? At least for me back in that time, it didn't make a lot of sense. Over time, as I tried to provide an analogy, I found it was like when I've learned 2 different languages, English and French, in my lifetime. I had to learn a structure. So some of the terms I'm going to use today is trying to get that structure comfortable for you as a business owner. So I welcome the questions. So just a bit of definitions here and assigning credits and debits in a minute. Revenue is, again, what you're trying to bring into the business. That is a sale. A sale or revenue is generally viewed as the same word, same concept, sorry. So the revenue itself has a credit balance. And I'm going to flip down to expenses. Expenses are generally costs you're incurring to be able to generate that revenue. So if you have a business selling a product, that would be the revenue on the credit side for the revenue. But then if that product cost is an expense and it's a debit balance. And again, why is one a credit and why is one a debit? It is the structure of the language. But in terms of, if you said, I don't know if this makes the way you're thinking, but on the balance sheet, the assets are debits, as I mentioned, whereas on the income statement, expenses, or money you spent, are also debits. It may not be intuitive, but it's almost, if you think of on the balance sheet, an asset is something of value, well, the expenses are still viewed as a debit balance, even though it's really not of value to you. I mean, you've spent the money, you don't have something going forward, but again, you've incurred that expense to allow you to get the revenue. But the main takeaway I'm trying to focus here is just to say, revenues are credits and expenses are debits. There's maybe a few slides up, or 1 or 2 slides at least. There's a bit of a chart, and I'll go through it in more detail, that'll summarize some of what I'm describing on these words here. So a debit is an accounting entry which results in either an increase in an asset or a decrease in liabilities or equity. And a credit is an accounting entry that results in either increase liabilities or equity or a decrease to assets. All of those are terminology descriptions to how debits and credits work. Again, if you're attending on the call and maybe you talk to your bookkeeper, or maybe you are the bookkeeper, but if it's something you're not that familiar with, you'll often hear accountants saying, well, I have to, or your bookkeeper would say, I have to debit this and credit this balance, and they'll go through whatever the example is, but it's more to make you familiar with the terms that in your bookkeeping world, you'll be using debit and credit, and it'll become a natural term to use as you start working through business discussions with your team. Certainly if you went to a bank or a financing, they're not going to ask you what's your debits and credits, but the debits and credits are the foundation, again, of how you create financial information for those people. So again, just a bit of description. Every transaction is a debit or a credit. So I mentioned that if you're a private company or a public company, everybody is in the same, and it doesn't matter what country you're in. This is the universality of it, that transactions always have a debit and a credit, and they always equal. So every transaction will have an equivalent debit and credit. So I'll give you an example. If you have a sale and you sold something to me for $1,000, your credit entry on the income statement is $1,000, assuming I paid you cash, just for purposes of the example. On the balance sheet, you'd have a debit to cash of $1,000. So $1,000 cash equals $1,000 of revenue. The cash is a debit, the revenue is a credit. 1,000 both ways. You've got a balanced entry. Debits and credits, how does it all work? Well, debits and credits, just like snowflakes that fell a couple days ago and result in snowbanks all over the city, your debits and credits accumulate throughout the year. So, you do a business maybe where you're selling small sales all day long, like a coffee shop. Each little coffee transaction, food item you're selling involves a debit and a credit. At the end of the day, you say, I've got so much revenue that day. Well, all of that revenue, that recording of revenue, is a summary of all these small transactions. The third point down are journal entries. So journal entries are non-cash entries. And from a bookkeeping point of view, you may make a sale to someone, and for some reason, this sale, you decided to sell to them on a credit basis. So you sold to me for $1,000. We both agree I'm not going to have to pay you for 30 days. And then I turn out to be a bad person and I don't pay you. So you're not going to get money for that sale. So the entry is not going to get fulfilled. You're not going to get the cash. What will happen is you have to get rid of that entry you previously set up to record the anticipated cash, which is called an accounts receivable. The only way to get rid of it is by a journal entry. So journal entries are used regularly to adjust balances for circumstances like I described, a sale that you made in good faith and your customer responded with bad faith and didn't pay you. So this is a very useful chart, I find, and again, when I'm presenting this in person, normally we provide hard copy slides, and at the start of the presentation, when I'm meeting with people to present this pre-COVID, I would often say to people at the start of the seminar saying, pull this slide out and keep it on your desk, because it really gives you a good pictorial of direction of how debits and credits work. Because again, giving back the analogy to language, learning English and French through practice, I learned some proficiency in language. Getting comfortable with debit and credit is the proficiency I'm hoping you get, and be able to understand some of these balances the way they work. So I won't read the slide because it's there for all of us to see, but it's a general overview of the way transactions will go, that you're going to have, as an example, just one line only on the asset side. If you want to increase it, you have to debit it. If you want to decrease it, you have to credit. Again, when you're working through bookkeeping, examples help the most. I'm going to have a few examples, and I think I won't be able to keep this slide open, but slides are available, of course, after the webinar if you wish. Keep this slide probably on your desk if you're actually trying to learn bookkeeping, because I think it'll help you work through the issues. That's kind of the high overview of the debits and credits. In a summary point of view, keeping track of your financial information requires you to learn the debits and the credits and the relationship of how they impact your balance sheet and your income statement. So if I just go back, because I'm going to go into a couple of examples here, I'm just going to go back a few slides. So the balance sheet is a concept of assets equals liabilities plus equity. Assets are typically a debit. Liabilities and equity are typically going to be credit balances. Assets are things of value to you as you run the business. Cash, accounts receivable is the obligation for someone to pay you money for a sale that you're going to get money for at a later date. Equipment would be an asset. Liabilities, again, are shareholder loan that one of the participants asked about. It's a credit balance. The company owes you money. Anything you owe to a supplier. Whereas equity at the very end, again, being an equation, assets equals liabilities plus equity. Equity will be a credit balance. If you're in a business and you've had a series of losses over the years, let's say you had income year 1 and year 2, 3 maybe, now you're into year 4, you might be having successive losses. The equity also is called deficit, And instead of being a credit balance for equity, it is a debit balance. Just again, a review for the income statement. So revenues minus expenses is net income. Again, very simple equations. There was only 3 components to the balance sheet equation. There's only 3 components to the income statement equation. So revenues are the proceeds from sales you're getting from your customers. It's a credit balance. Expenses are costs, maybe labor, materials, rent, etc., that you needed to incur to get the revenue. So expenses are always a debit balance, and net income is the residual. And if you've got net income, it's a credit balance. So if you have $1,000 of revenue, which is a credit, and $700 of expenses, which is a debit, 1,000 credit minus a 700 debit gives you a $300 number balance, but the signature on it is a credit. So again, maybe it's the opposite way. You had 700 of revenue, you had 1,000 of expenses. 700 revenue is a credit, 1,000 expenses is a debit. The net income is not that. It's called a net loss, and it's a debit. Always an equation. What I'd like to do now is just go through some bookkeeping issues. Again, this will involve some formatting, and so I thought HST and accounts receivable and payable, just to give you a sense of how the journal entries work. So this is just a bit of an overview on HST. In case you're on the call and you're, a lot of this information, again, we do different seminars, webinars now with Invest Ottawa. If you have further questions, if it's not within our own webinar series at Logan Katz, please check Invest Ottawa, because there's a number of seminars put on by different firms. We do a number of them there, and we do definitely do a very good full bookkeeping session, as I mentioned, which will go through this in a bit more detail. But the point in this one is just to say HST, if you're in business and you're on this call, HST is something that we're all going to have in our business, because once you're above 30,000 in revenue in any 4 quarters, so in any year, once you're above 30,000, you must register for HST, and therefore you have to start charging the HST. This also applies for QST in the province of Quebec, same threshold. So this is literally the debits and credits that go with the bookkeeping. I mentioned before debit and credit balances. So this is just assuming you've got a sale of $40,000. Again, it's a credit balance. If you're going to have HST on the sale, which you will if you're a registrant, it's in this case, province of Ontario rate 13%, it's $5,200. It's a credit. Why is it a credit? Because that HST is not your money. You owe it to the government, because you're collecting on behalf of the government, because the government requires us to charge HST once we're above those thresholds. Again, debit balance for the accounts receivable, the $45,200 is just the math equivalent of what the sale value was in the HST. So debit equals the credits. Similar example here, just again for HST purposes. So that's on your revenue side. Let's say you are renting a premises right now, and the rent was $10,000. Your landlord would be charging you $1,300 on the $10,000, because it's at 13%. And you would have to pay that person, the landlord, $11,300. Again, a debit on the expense side. If you remember the income statement, expenses are debits, so it's a debit balance. HST payable is a debit. Why is it a debit to the payable? Because David Logan, who's doing this seminar, says payables are always going to be a credit balance. In this case, the $1,300 is a reduction of what you owe here on the $5,200. So I'm just going to go back to that little table. So liabilities, increase them as a credit. To reduce a liability is a debit. And the reason I'm pointing that out is on this example, you're setting up a liability here because you owe the government $5,200. Through paying HST, you're probably aware that you get, as an HST registrant, the ability to claim back from the government the HST you paid. So it's HST payable. The reason you're debiting the payable is because you're reducing liability here by the 1,300, and that's why it's a debit. And again, the two debits equal the credits. So just a very simple comment here. At the end of the year, you know, the 5,200 you normally owe, less than 1,300, it's $3,900. And that's just the sort of the interchange of debit and credit.
David, I have another question here.
Yeah, please.
Okay. So for new entrepreneurs, it says, unsure whether I will earn 30K in a year. Should I still register for HST? Can I consult for the first part of the year and then just register once I get close to 30K?
Yes. So yes. So why would you register early if you're not at the 30,000? I'll give you the pro and con both ways. So registering early allows you to claim input credit. So even though you may not be generating revenue, you may be incurring expenses, and the expenses would have an HST cost on them. So again, if you're not registered for HST, you can't claim those HST input credits. So my suggestion is registering early. The pro gives you the ability to claim the input credits as a refund. And so quite often in a lot of the startup companies we see, they'll be in a refund position because even though they anticipate they're going to be slow in generating revenues, they know they'll get to a revenue position requiring a registration, but they want to take advantage of the recovery. The negative to registering early, it's more administrative work. When you first register for HST, up to $1.5 million in revenue, you are an annual filer, meaning you only have to file one return. You can elect to go quarterly. There is a burden of paperwork with an HST registrant to file HST returns at a minimum once a year and then pay quarterly installments, or it can go as frequently as quarterly or monthly, depending on the revenue levels of the business. So the pro is registering early. You get the ability to claim input credits. The negative is a bit more paperwork. If you're towards the end of the year, you're approaching $30,000. The revenue up to that point, you haven't charged HST. You haven't been able to claim the HST, no issue. But once you're over the threshold of the 30, you're deemed to be a registrant, meaning you have to charge it. And then you can start claiming the input credits. Often what I'll say to people, and it's more of a marketing concept, you can judge if you agree with me or not. When you're showing your sales invoice, if you are an HST registrant, you must show the number on the invoice. That's a requirement because whoever you're selling something to, the HST that they're paying to you, they can claim as an input credit, so they can get it back from the government. When you're showing someone that you're not an HST registrant, you're telling them your overall business volume is less than 30,000 annually. That's the marketing component I'm talking about. It suggests, 30,000 is a relatively low threshold for revenue because that's not income, that's revenue. So my own suggestion sometimes is if you're planning to be in business and you know your thresholds of revenue, you're going to hit 75,000 the first year, you're going to hit whatever the number is, but you're going to easily get up to that 30,000. My own thought is start registering as soon as you start business. Start claiming input credits, show your HST number as required on the invoice, because I think there's some marketing value to show that you've got some substantial presence, you're above that 30,000 threshold.
And David, we have another question.
Yeah.
Is rental income considered as sales?
Yes. Rental income is sales. So anything that results in an inflow of money to the business from a customer, or so a tenant is a customer. So as an example, if you own a building, that rental income is revenue. Whether it's commercial or residential, it's still revenue. Commercial attracts HST. Residential doesn't attract HST, but it's still revenue. So bookkeeping tools, again, when you're doing your own bookkeeping or if you're looking at it, I mentioned before these debits and credits. If you're trying to do your own bookkeeping, often we run into people, they'll start with Excel spreadsheets, which make a lot of sense if your business volume is relatively low. If you're aware of how Excel works, it's pretty easy to set up a model to keep track of your revenues, keep track of what you spend money on, the expenses. It gives you enough information with the sum function within Excel to say, here's my revenues, here's my expenses, and you've got some pretty good information. The scalability of that type of a spreadsheet is it's very hard to scale, and it's hard to get reports from it that are useful. And that's why most businesses at some point will migrate to some sort of a software. The software that's out there, there's numerous softwares that we see because we work with several thousand clients. QuickBooks, QuickBooks Online, another one is called Sage. There's many others. What you're looking for is a software that you can understand. If you're employing a bookkeeper, my suggestion is make sure the bookkeeper who's doing your bookkeeping, you're aware what software they're using. Again, if it's an online version, clearly you can access it because it's online, but if they're still using a desktop software, make sure you have the equivalent software that if your bookkeeper decides not to do work with you anymore, that you've got an ability to open up your own data and look at the information. The business reporting issues, and coming back to the whole theme of why we're doing these webinars for the COVID-19 world, once you've aggregated all your bookkeeping information and you've got it in a format that's, let's say it's on a spreadsheet, what I'm looking for as a business owner myself is information I can use to make decisions on how to better serve a customer, how to do things differently on the expense side in a business. Spreadsheets will give you some information on that, but even the most inexpensive version of QuickBooks or QuickBooks Online or Sage has all sorts of preformed reporting options built within it that just takes that data that you've put into QuickBooks, Sage, or QuickBooks Online and give you good reporting. So I'm definitely pushing, I'd say, towards using a software. I think you're going to have better success long-term trying to get information.
And we have another question here.
Yeah, please.
I am renting an apartment to run my business from. Is that considered commercial or residential? Should I be paying HST on the rent to my landlord?
Well, I don't know all the facts, but I'll try and interpret it. So if you're taking your residential apartment and running your business from it, it's strictly a residential rent, and your landlord is charging you for like a residence. It's not a commercial enterprise, so it's not a commercial rent, and HST wouldn't be charged. That's so. My facts, I'm assuming, are you live in the apartment, you're paying rent to your landlord is not charging you HST, which is correct because it's residential. But in the COVID world, you're running a business from your home. Again, that doesn't transition the rent to commercial rent. It just means you claim a portion of your apartment, your home, for business. And you can claim that again as business use of your apartment, your home, for tax purposes. I hope that answers the question. The bookkeeping activities is startup cost, and I'm just coming down to a bit of discussion here. When you're doing your own bookkeeping, strengthening the importance of it, I think it makes sense to dive in yourself if you own the business, even if you're not a bookkeeper, at least to get a sense of how it works. At some point, as you start to grow your business, you probably will find that your time is better served to look after other elements of the business that are your natural strengths. If otherwise you said, look, I'm busy enough as it is, I'm just not going to do the bookkeeping, I discourage you from doing that because it comes back to that central theme. You need information at all times, but probably more so now than ever. If you're doing any of the reporting for SUS or the commercial rent subsidy that's now out to replace the prior rent subsidy, so you are going to need financial information. So my concept is it often does make sense to engage a bookkeeper if you're busy and budget for that person. Within the Ottawa area, there's lots of good bookkeepers. What I'd look for if you're in a business and you're not going to continue doing your own bookkeeping or you don't want to do it, find a bookkeeper that's familiar with the business line you're doing. So if you are a retailer and you've got inventory, there's different issues on bookkeeping with inventory than if you are a service-based business. Maybe you're a consultant, and so you clearly don't have inventory. What you're looking for is a bookkeeper, someone you can relate to, that understands your business. And again, coming back to it, make sure you understand what software they're using, and look for that basic reporting that I talked about. You'd want a balance sheet and an income statement. And the final slide is just a bit of information. It's got our contacts at our office and such, but it's also got a hot link to our website. So we've got a lot of COVID-19 resources. One of our partners, Angeli DeLowry, and Stacy have put together a lot of information that's very useful. So again, not so much directly related to bookkeeping, but our central theme of assisting in the COVID-19 world is to go to the site and just see if there's any programs as you're navigating the latter part of 2020 into 21 to see if there's any programs that are assistance to you. The government subsidy programs is what I'm talking about. Now, I went through the material. It's only about 36 minutes into it. When I do the presentation at Invest Ottawa, I actually go through a bookkeeping exercise. I knew there wouldn't be time enough today in the hour-long call, but the bookkeeping webinar that I do with Invest Ottawa actually goes through a series of transactions and shows how the various reports, the income statement and balance sheet, are prepared. So again, just encouraging you, if you want further information, if this seems like a topic you want to know more about, please consult that. There's no charge for the Invest Ottawa webinar. And you're always welcome, of course, to go to other webinars, but the one that we put on for bookkeeping, it'll give you a more complete overview of the bookkeeping process. I think that's all I got today to talk about for this topic. Stacey, are there any other questions?
So far, no. Oh, there's one now.
Okay.
It's not a question. They're just wishing you and your family a Merry Christmas.
Oh, thank you. Very kind of you.
They said, yes, you look like your father.
I think it'll be a good year for all of us in business. I mean, I'm trying to be optimistic and a business person because I think it's important. But it's the reach out, and that comes back to our central series of webinars we're doing now. We've done some, there's a few more to come. But if you have topics you'd like us to focus upon or represent, please let us know. Again, the outreach is really to say we're very much aware that the economy itself is in struggling times for certain businesses, some more so than others. Where we tried to put our efforts was to come up with topics we thought that might be of use to people who are working through the pandemic from the business side. We can't help on the health side, but on the business side. So please feel free to reach out if you have other topics you want us to talk about, and join subsequent webinars too.
We have two more questions that just popped up.
Sure.
So what are the differences between an owner's loan and invested capital?
So an owner's loan and invested capital are both credits on the balance sheet. They're similar. What's the difference is, I'll work through a simple example. Let's say you were starting your business and you wanted to put $15,000 into the business. You determined you need $15,000 of cash. You had $15,000 of cash, and you want to put it into your corporate entity. I would recommend you put in a very small amount for the capital, which I'll call share capital. So a corporation, you can only become a shareholder if you subscribe and pay for the shares. So again, none of us can be a shareholder in any public company unless you buy the shares. So again, in your own private corporation, you actually have to subscribe and pay for shares. So of the 15,000, if you want to put money in, I would put the smallest amount possible, perhaps $10, maybe $100 in for the capital. That's on the equity side. And then on the liability side, I put the balance. So I'm assuming 15,000 of cash, so I'll say I put 14,900 in as a shareholder loan. That's a liability, and I put $100 in as capital stock, and that's a credit on the equity side. Why do it that way? When things start going very well for your company, you're starting to get money into the business, and you want to take the money out. It's very easy for the corporation to write you a check back against the loan you put in. In fact, it's as simple as that. You just, if the company owes you 14,900 and it had $10,000 to pay out to you, it would just literally debit the payable 10,000 and credit cash because you're taking cash out. Now, if you'd put all 15,000 in as capital stock, you did not regard any of it as a loan, so it's all sitting as capital under capital stock, the 15,000. There is a mechanism. It's called a paid up capital reduction. It's a bit of a legal issue to look after. It's not a problem. It's just a legal issue. What you're saying is, I'm going to reduce what I paid for my shares. You still own the shares, but you're going to do a paid up capital reduction, and can be done. But my suggestion, virtually for all of our clients that I meet, is to put the 15,000 in predominantly as a loan.
And the next question is, what if it is a zero interest loan?
From the shareholder? There's no issue if it's a shareholder loan at zero interest. What will happen is you as a shareholder can loan money to the business because you have the opportunity to earn income from the business through dividends, let's say. If it's a family member loaning money to your business, your corporation to be specific, the family member should, and I'm assuming your family member is lending money to the corporation but not being a shareholder. In that case, the family member should charge interest on the loan to the corporation. And the reason they do that is want to be able, in case the loan can't get paid back, to be able to claim what's called an allowable business investment loss for that family member that loaned the money in. That's a particular type of capital loss. And Canada Revenue Agency says that person can only claim that allowable business investment loss if the loan has gone bad, if they had an ability to earn income on it. And that's why I'm insisting that if it's a family member making a loan to a corporation, the corporation must set up that loan with interest. When it's the shareholder loaning money to the business, the shareholder could charge interest or not, but ultimately the shareholder has the ability to earn income because they could take dividends. So that's kind of a more complete answer, but that's the difference in the two types of loan: a shareholder loan versus a family member loaning to the business.
Okay, and the next question is, can a corporation have its own investment account, so a broker?
Yes, like if I understand the question correctly, and I think I do, a corporation can hold investments just as, these are marketable securities. I think we're talking about like shares in public companies, et cetera. So again, very common that the corporation itself will have investments. You personally may have investments, but the corporation absolutely can. So yes.
Okay, and I think that's it for the questions.
Okay, well then, thank you all for attending today. I know your time is important too, so I don't want to hold people on for more time than needed, but I appreciate the opportunity to have everybody on the call today, and hope you have a great rest of the day today. Goodbye.